bring in Dino Kos, Hamiltonian Advisors, with us to talk about the new banking and filter this into all the turmoil that's out there. Remarkable. When I say the new banking, am I right, or are we just going right back to the old banking?
We'll make the argument we're going more back to the old banking. You know, there's a lot of regulatory pressure to cut back on some of the capital markets activities from some of the big banks because of Basel III, Volcker rule, things like that. So you're going to have more pressure to actually go back to some of the older banks. However, that's got some issues as well because of things like the flat yield curve that you mentioned, some of the Fed's policies, which are not going to help to be profitable in the old banking.
Can they develop a cash flow, and then can they develop a yield and dividend growth that will make them look very utility-like?
They can, but again, it has to be a business model that goes along with the regulatory model. The utilities, as you mentioned, there's a regulatory structure that makes that work, and we don't really have a regulatory structure that's married to that kind of a business model. We might in the future, but we're not there yet.
Let's go a macro chart here, long-term view. We showed this before, investment component of GDP, and it just, it's not there. It's just gone flat. This is GDP investment, semi-log, slope matters, growth and investment has disappeared. Has it just gone abroad, and that's where Citigroup and JP Morgan's going to go to?
Well, you know, this is one of the great questions, right? You know, because people are waiting for the investment boom to come, and there is some investment. You know, it's in the GDP data. You got to look, but it's there. But you have a point. There's the cash that's on the corporate bank balance sheets, but a lot of that cash is overseas. So Microsoft buying Skype is a great example of $8 billion of cash that was sitting overseas that's being used to buy a foreign company. You know, that cash hasn't yet come back, probably won't anytime soon. You know, and so these companies are going to find investment opportunities, but not necessarily here.
Have you figured out how to use Skype?
Barely. Barely.
I'm lost. I've tried like 4 times. Anybody that knows how to use Skype, email me, tkeene@bloomberg.net. Note here, let's go right to it. Research note. I wanted to digress here. Here's like the real business of making money. Great interview this morning. Christian Weatherby, Citigroup, on railroads. Rail operating performance was mixed in week 31 as average velocity. I love velocity, but this is like trains. It increased 0.2% to 23.7 miles an hour. But terminal dwell time deteriorated to 22.6. I love that. What's the terminal dwell time of Bank of America?
I have no idea what any of that means.
I have no idea. But if you bring that industrial stuff over to the banking industry, you have metrics and others do about how we measure the efficiency. And what's the terminal dwell time of B of A?
Well, I don't know. I mean, you know, your one metric, of course, is people, costs versus revenues. Now, you know, and right now we're seeing that the banks are trying to get more efficient. You know, a lot of articles, headlines about cutting costs, cutting jobs, and that's one way that the banks, I think the banks are seeing the revenue pressures that are ahead. You know, they're facing them now, they will continue to face them. You know, if you just look at the sort of 3 ways that banks make money. So one is net interest income. Well, flat yield curve, you can't lower your deposit rates anymore, although Bank of New York is trying. You know, so your net interest income is compressed. Fees, well, we saw what happened with the interchange fees and the so-called Durbin Amendment. That got crushed. And then you've got capital markets, and again, you know, regulatory pressures and leverage pressures around these banks. So it's hard to make money, and you know, and so now they're trying to get ahead on the cost side.
Can Chairman Bernanke give the gift that keeps on giving, which is a steeper yield curve to help net interest income?
Well, he's going the other way. Right? I mean, he's actually, you know, what they did last week by promising to keep rates low for a long time has the effect of flattening the curve. So it's really going in the other direction. You know, right after when the crisis first hit, the Fed lowered interest rates, the yield curve steepened out. It was a great time to be lending and capturing that wide spread. Now we're going in the other.
Over.
The gift's over. That's the irony, is that, you know, if it's good for the borrower to refinance at these lower rates, you know, it's bad for the bank by definition because the bank can't lower its cost of funding anymore.
What do you hear anecdotally within Manhattan Wall Street? I talk about global Wall Street, but with all of your contacts, what are you hearing from quote-unquote bankers?
Look, I think the bankers know that they have these. Revenues is the big word, right? So the revenues it's these revenue headwinds that are here that the banks are confronting, and then what do you do with them? You can't sort of magically generate revenues, and so you've got to deal with the cost side to maintain profitability. There was this note in one of the articles today by Credit Suisse, for example, which sort of had this, astronomical cost to revenue ratio in the second quarter, and then it sort of forced them to cut back on staff, and that's what they're doing.
Let's bring up today's chart. Subdata, the Empire State Manufacturing Survey, I believe out of Buffalo, but down it goes again. This is not the nominal GDP environment banks love, is it?
Absolutely not. Nominal GDP. People live in a nominal world, not a real world, as it were. And when nominal GDP is weak, it gums up the works, as it were, and banks feel the effect of that.
I mean, you look at that. I mean, are we talking about layoffs? I don't want to pin you down here before Labor Day, but they've got to rationalize those expenses you were talking about earlier. Do you have a working number in your head of how much we'll see in layoffs?
I don't have a working number in my head, but it's clear that the banks expected a recovery. They expected a sharp recovery.
Right out of 2009, we see that at Bloomberg. Full disclosure, with the terminal.
Right, and you had staffing then ramping right back up, and now the business just isn't coming through, and so now you're having this pullback. The other thing that you're having is there's the second leg in housing. Right now, the banks took a lot of losses on housing-related exposures during the crisis and right afterwards. What they didn't expect was that there would be this second wave of losses that would be coming because of the so-called reps and warranties.
Right.
There was this great term, originate to distribute. You make the loans and then you distribute them to into MBS and others pools of securities. Well, those things are now coming back. The investors who bought them are saying that the banks did not quite do their jobs, and boom, there's another wave of losses.
Will the pain, the relative pain, be on retail banking, or will it be on institutional banking?
Wow, that's probably a little of each, because you've got, again, sort of retail includes housing, and there's some more to go on the housing side, and then on the wholesale side, again, in capital markets, the banks just seem to be a little overstaffed still, not enough business to go around for the cost structure. So you're probably going to get a little on both.
Here's a chart we've been showing. It shows real and nominal, and again, I have to get up above the 4% line. That green line back to 2001, real GDP, that blue line, what a disappointment the first 6 months. And the white line is that nominal coming under 4%. Doesn't that say consolidation to you? Gerard Cassidy at RBC loves PNC Financial. Will there be a frenzy of consolidation as they can't cut fixed costs?
There will be an attempt to consolidate. Now, the big guys can't, because they're quote too big to fail, so the regulators won't let them, and they're hitting up against regulatory constraints because they already have
level in there.
Exactly, deposit levels, and so you have the next layer down, like a PNC, that actually are really good stories in a way, because they're not on the radar screen. They'll be able to buy some of these weaker banks that the bigger banks cannot. So actually, that's not bad.
Okay, here's a chart. This is just productivity. It's too much information. Let's bring it up right now. One of the productivity series, I'm going to start featuring more on productivity. This is just the nation's output per hour. And you got movement in the denominator and the numerator as well. And did I spell that right? Technological progress. I hate this word innovation. Where is the technological progress in finance? It's almost 19th century to me.
You remember Paul Volcker's famous line a few years ago? He said he hears about all of this financial engineering, but as far as he can see, the ATM is the most noteworthy invention in banking.
Remember how Diebold did that? I was like, wow, that's cool.
Look, there are innovations. Exactly what their value is, is something that I'll leave to others to guess. I'll leave it for the financial engineers in academia to figure it out.
I was sitting in a Beijing hotel, and they opened an FT, and it said CDO squared. And I said, what is that? That's the kind of stuff you're talking. Those days are gone?
Well, I mean, unfortunately not. Bloomberg puts out this newsletter on structured products.
Yes, Bloomberg Briefs, Ted Merz and the team. Yes.
Exactly. And so you can kind of see that some of that stuff has come back. There is demand from some sources for those kinds of products. So as long as there's demand, Wall Street will pump it out.
Did the KKRs of the world do well?
I think they will. I mean, these kinds of markets create they create opportunities. Assets companies get mispriced, and those guys are the kinds of guys who will come in and try to identify them.
Thank you so much for coming by. Dino Kos with us.